Not a coincidence that some of the best traders of all time traded and still trade momentum-based strategies. Guys like Paul Tudor Jones, Mark Minervini, and then David Ryan, some of the guys who've won the US investing championships, which have tracked and logged people's trading results over the course of individual years. These guys have a lot in common, even though they do trade differently, and not everyone's going to trade the exact same way, and no one's going to give you the exact indicators or metrics or whatever that they specifically use. The concepts reign supreme. Timing is important. Trading when the risk reward is in your favor, when you have a trading edge, is also very important, but it's your job to create a plan, have an edge, and execute that plan based off that edge in order to make money in the markets consistently. So let's get right into it. Now, first things first, there are a lot of questions I'm sure that people are going to ask, and I want to take a second to answer them. First, what asset classes does momentum trading work for? It does not matter. It can work for any asset class that you want to trade. It can work. You might find that a specific set of criteria, a specific strategy that you used for stocks does not just translate right over to Forex. There will be tweaks that have to be made, but they can work. There just might need to be tweaks if you're moving from one way or from one asset class to another. That's just something you got to keep in mind. Next is, what time frames does this work on? Well, momentum trading can work on any time frame. I know myself, I used to always think that, the 1 minute chart, the 5 minute chart, even the 15-minute chart, like where it's all at. But as time has gone on, I have realized, and I've started trading on larger time frames. So thinking more 4-hour charts, 1-hour charts sometimes, mostly daily charts and even weekly charts. So big picture time frames. And I found that a lot of the same things that I used to do on the 1 minute and 5 minute charts have translated beautifully, and actually even better from a stats perspective, to the bigger time frames. It's just the trades take longer, and that's just something you have to size accordingly and work into creating your strategy. Now let's talk about what is and then what isn't momentum trading. So we're looking for breakouts and breakdowns. In the case of what we have on the screen right here, what do we see? It's consolidation, and we're starting to break out of that consolidation. Okay, we are looking to trade when we have breaks in consolidation or with a trend, as long as that trend is continued to be respected. And we'll have some examples here in just a few minutes. What we are not trading with momentum is inside of here. Why would we trade inside of here? Price had just made a large momentum-based move up, and it is now in consolidation, and it hasn't given us any signs of breaking that consolidation as the consolidation establishes itself. One of the easiest ways to get caught up and lose when you're a momentum trader is the beginning of consolidation. That's also something we can't really avoid because we can't predict the market. But what we can avoid is, as the consolidation, as time goes on, we can avoid trying to trade inside of here. Okay? So you can't avoid this, but you can avoid this. After a range has been established and we're not breaking that with high volume for a period of time that starts to extend based off the time frames and the charts we're looking at to become statistically significant. Now, this was a very strong trend, but we have a very strong move to the upside, and so you can also trade momentum with a trend retest and continuation, as long as it's a strong trend and as long as that trend is respected for a period of time. I like to use a 3-touch technique where a trend line is touched 3 times to establish a trend. And then until that breaks, I have that trend line on my charts and I'll use that. Personally, that's not the way that I trade now, but that's a way that I track, follow, and watch trends. I don't trade 2 ways. I trade 1 way. Personally, it's consolidation breaks. That's what I do. But that's not the only way you could momentum trade. There's a lot of ways to momentum trade. These are kind of like the core concepts to momentum trading that should be something that's, in the back of your head and respected in your trading big picture. So let's now get into the keys of momentum trading. One of those is higher time frame trend. So if we're going to play a trend bounce or respect, or we're going to play a breakout of consolidation, do we have a higher time frame trend? Well, in this case, right, we've got the Dow Jones, right, very strong trend to the upside, right, even in here. And if you're playing the break of this consolidation right here, Well, yeah, you're playing it after we've had a strong trend to the upside, and all we're doing is consolidating. Now we're breaking that consolidation, and so you're looking for the next leg. I'm not trying to predict when we roll over and fall off. There's also ways to do that, momentum based, but I'm just trying to play with that underlying trend in my favor, and this is what gives me an edge. Now, we talked about the breaking consolidation, but another key is waiting for that break. If you get in early or ahead of time, you could be asking for trouble. So if you do so, make sure you know what you're doing and you have stats and trading data to back up your anticipation buys, because I see that and I used to do that a lot, but I found that it's just not worth my time to try to get in here because I think we're going to break it tomorrow, when I could just wait for tomorrow and then trade it later on and use my usual trading plan anyway. But the next piece is risk reward. We need to have good risk reward. So if you look at this, and we even have a smaller example of a consolidation break on the Dow right in here. When trading this, if you're going to come in here and you're going to have very, very tight risk reward, meaning you're going to risk a little to make a lot, that's good, that's okay. But understand that price doesn't have to always break it and go. Price can take its time. Price might backtest a bit. So based off of what you're doing, what you've seen, and your trading data, that can change. However, thinking of risk first before the reward is a great way to go about it. So if I see the bottom of this consolidations right here and I say, hey, if we break that consolidation, that means our trend to the upside is no longer looking good. I'm going to get out. When I place this trade and I get in on the break of consolidation, I'm going to put my stop loss at the bottom of that consolidation, and then I'm going to think about targets. I'm going to think about how much of a move can we see. I'm going to think about the Dow Jones ATR. What's the average true range? What does it usually average on a given day? I'm going to look back to the left. I'm going to see, okay, the Dow moved up on the recent break of consolidation, or the recent move it just saw. We had a move from 346 all the way before this consolidation of 360. That's roughly a $14, $15 move. I'm going to look for $10+ on this. I'm going to start taking profits at 10 and I'll scale out from there. So that's a way to back yourself into this. And if that makes sense and that reward is larger than the risk, well, that could be a very good trade. Again, you don't have to have a larger reward than your risk if your win rate is very, very high, but there's a very good chance that your win rate is not going to be massively over 50%. And so if it's not massively over 50%, we're talking 70+%, then risking less than your reward on a given trade is a great place to start, because that's going to guarantee profitability with a win rate around 50%. That right there is our job as momentum traders. We must respect those rules, respect that risk, create our plans, because price is going to do what price is going to do. That'll always be there. There'll be other asset classes. There's always going to be more to look at. But that is all we have to do at the end of the day. It does not need to be a lot more complicated than that. In crafting that strategy, there's a couple things that play into it. I'd recommend 25+ trades, whether that's paper trades, whether that's real money trades, and getting that screen time up. You don't have to watch the market during the day. This is TradingView. This platform right here is TradingView. What I could do is I could literally go to the trade replay and I could replay price action over the course of time. And I could go back and watch 5-minute candles. I can go back and watch daily candles. I can go do whatever I want to do in my free time, after work, before work, at 2 a.m., whatever, in order to benefit myself and craft and create my trading plan and get the reps, get the mental reps, so that I can ultimately start to do this with real money or get better and get the data that I need for my momentum trading strategy. I went back to look at my momentum trading over the past 6 to 12 months, and it probably took a good 100 trades for me to get to that point of complete confidence in my strategy, knowing I had an edge, knowing I was solid with my risk management, knowing my numbers and my stats, knowing my setups, knowing what to look for. And there's critiques to be made over time, for sure. But it probably took me about 100 trades. Just so you have some reference, that's a lot. That takes time. This is not a overnight get-rich-quick scheme. It's real trading, and I use TradeZella to track, journal, and log all that stuff. So I got that data in a much more visually appealing and easy to digest way where I can go and act upon that. I'll leave a link to TradeZella below this video. So whether you're new, haven't gotten the screen time, or want some more examples, let's cover 2 of the concepts or trading styles in a momentum strategy that you can utilize. Here's one of them. Here's NVIDIA. Here's the weekly chart. What we have is a big move up. The trend is moving in our direction, right to the upside. We've got now a consolidation. We've got a clear line of resistance around 505 or so on NVIDIA, and the bottom of the consolidation is around $400. So we have about $100 level of consolidation on NVDA. And what I'm looking for is a break of that consolidation. So a trade example could be getting in on the break above, looking for the most recent higher low to risk off of. So for example, if NVIDIA gets above 505, I'm going to risk this low right here, which was dead right around 450. And I'm going to target a rough 2-to-1 risk reward just to see if that ends up panning out. And so what I'm going to do is click on the play button here, watch the trade play out. I'm going to take the trade, I'm going to journal it, I'm going to log it, and I'm going to see what happens if it triggers. That's what it's all about at the end of the day. We're waiting to see what happens when the trade triggers, and then from there, we're journaling, logging, noting the data, noting what we get, and making any adjustments that we need to make. Here's another one, Snowflake. Recent trend to the upside the past couple of months. We had an area of consolidation and resistance. We could not break above this, and we held this 182. What we have is a break to the upside. I'm going to use the recent lows of this past week on the chart as my downside risk. Then there's a gap to the downside here, and if we were to break out and then we were to fall back underneath these lows, in my opinion, well, the timing is off and the momentum is no longer there. I want to see us push up, maybe back test, and continue with high volume, which we see at the bottom of our screen. If we don't, momentum's not there, take the loss and move on. Again, I don't need to be right on all these trades. If I'm right half the time and I'm risking less than I'm looking to make, I'm going to be profitable, big picture, with a large sample size of data. Here's a great example of a fail. Home Depot just broke this level right here by a few dollars. It pushed up, and then it failed. So if I use the bottom of the consolidation as my stop loss, we would have gotten taken out. I would have gotten in, it would have been up for a little bit, and then it would have went right down, and I would have gotten stopped out. That's an example of it failing. You just cannot say to yourself, oh, the market's been going up. Even though this is down, I'm going to stay in because I think it'll eventually go up. And it might. It might, but what if it doesn't? The market rolls over from here and Home Depot falls off a lot more. You now have a huge loss compared to what you were looking to make, and it's no longer worth it. And that's going to completely derail your trading strategy and your trading results long term. You just can't have it. You stop out, you move on to the next one. It doesn't matter. There's going to be so many more. So who cares? Now, the second style is a trend respect. In this case, you have a very strong trend with Meta. You've got multiple touches down here. You've got a touch here, and then you actually came close right here. So what I would say with this is that if you are looking to get in on Meta and you're like, hey, I got a really strong stock here and I'm going to play with the trend until that trend breaks, you had opportunities back in here and back in here. Now, what I would recommend on something like this, and again, anyone can craft, there's no one way to trade this stuff, which is what I think is awesome about it. So go off and do what you want to do, try things and test things and adjust from there. But when you see big lower wicks, when you get a signal or you see a bounce on high volume off of the trend line, those are good signals that say, oh, the trend line is still being respected and I'm going to get in here. It's not a breakout of consolidation, but I'm going to get in here and I'm going to use the bottom of the day that I got that signal as my risk, and I'm going to trade for a 1.5 or a 3 risk reward. I look to make 3, risk 1, something along those lines, and back your way into a strategy from there. But this is a way to go about it. Pfizer's a good example of the exact same thing, but to the downside. This has been trending down for some time. You had multiple touches of the trend line up here. You even had a steeper trend line in here. When Pfizer respects this and starts to sell off on high volume, as we saw back here, this could have been an opportunity to get in and short, and then Pfizer had a very big move to the downside. Now what has Pfizer done? It's now not respecting this downtrend. It's actually gotten above it and now potentially putting in a higher low. This is no longer respected. I will not trade to the downside on Pfizer until I can establish a new trend to the downside, which we actually may have one developing here soon, but that's what I'm going to wait for. Waiting for that trigger, waiting for that continuation of the trend to the downside before I actually get in, or before I look for triggers to get in and then an area to risk based off the chart. This should be a great place to start when it comes to momentum trading. There's a lot more we can get into, the intricacies and then the details of specific styles. We've got some other videos on the channel if you want to learn more about that. I'll leave a link to TradeZilla where we track, journal, log, makes everything so much easier from a data and a numbers perspective when it comes to your own trading. I'll leave again that link down below. I've been using them for well over a year, and they've been huge in helping me understand my data so that I can improve it and move on to bigger, better things, and then ultimately scale up over time. Maybe leave a like, maybe subscribe if you guys want more, and I'll see you next week. Peace.